Hi everyone, welcome to JEDi episode 11. My name is Jimmy and with me today are Ethan, David, and our special guest, Lyndon.
Hello.
For those of you who tune in to our Facebook Live for the first time, and if you want to know more about us and the name JEDi, do check out our first episode in the video section. I'll be the moderator for this episode. So here's kind of how we'll run through. We will first address a question from the previous episode on credit card hacks part 2. And then Ethan, David, and Lyndon will be having a fireside chat on CPF hacks part 3. And then there will be a bonus section on how to create CPF ordinary account shield, special account shield, and trader endowment policy shield. Then last but not least, we'll have a Q&A section. So feel free to post your questions in the comment section below and we'll address them during the Q&A section. So without further ado, we'll start with questions that were raised during our previous episode. I'll let Ethan start the ball rolling. Ethan?
Okay, hi everyone. I'm Ethan, founder of PolicyWoke. So for the last CPF Hacks, we didn't receive much questions, but we found that there are quite a number of things to maybe go through again. And so this is for today's content. So we first talk about what is SRS, Supplementary Retirement Scheme, and followed by the limits for the OA investments and what other potential hacks that the general public can use. Okay, so first thing first, what is SRS? So it's actually basically a tax saving scheme for higher income earners. So there is a cap of about $15,300, and it is a lot more flexible compared to CPF special account. But there is a penalty, which means if you draw from it, there's a 5% penalty that you need to pay. And also the amount that you withdraw will be income taxable in that year. So this is the summary of what is SRS. So it's actually a bank account that lets you deposit money for tax relief. However, the interest is really miserable at 0.05%. And there are actually better options for better returns. So for the very, very conservative people, you can actually buy a single premium annuity from any of the insurers that provides it. Or you can even invest with Endowers, Money Hours, StashAway, or even any other brokerages like iFast, OCBC to invest your SRS. So let's talk about the limits for CPF-OA investment. So I think a lot of people understand that you are able to invest your CPF-OA, but there's a need to dive deep into what you can do. So there's actually a few limits. The first one is you can only invest up to 10% into gold. But 10% is more about 10% of the amount of available OA you have, minus away the 20K that is in reserve, whichever is lower. So for example, for gold, let's say you have 30K, you can only invest 10%, which is 3K into gold. So that's for the first one. For the second one, up to 35% allowable stocks. So 35% is more about individual stocks like DBS or SingPost or Singtel. So for example, the same thing, you can only have, you have 30K in your OA and up to 10.5K can do investment. But because you need to reserve 20K in your ordinary account, so you can only invest 10K instead of 10.5K. So there's two needs to take off of. One is the 35% limit. The other is the limit that you need to reserve your 20K in your ordinary account. Okay. There's actually another one, but there is no limit to this, which is you invest into funds that is CPF-OA approved. So if you want to find out more, you can actually check with FSM1 or any other brokerages. You'll gladly help you and handhold you. So in this episode, we are not going to do that. Please look for brokerages. If you need any brokerage recommendations, you can find us. So let's move on. Okay, so let's go to the CPF Hacks in general. So the first one that we talk about is if you wish to top up CPF, you really need to do it as early as possible because the interest earned is calculated at the lowest amount for the month. So we need to say that in January, the lowest balance in the month is 30K. So in January, maybe you have a 30K, then your employment contributed another 2K in, you top up another 7K in, but for January, the interest earned is on 30K instead of 39K. This 39K is only reflected in February. But if you want your tax relief, you can do that in December one. So that's why January is actually the best month to top up if you have the cash. Okay, for the second one, you can actually top up your parents' retirement account with cash. So this actually enjoys another 7,000 tax relief if they have less than FRS. So the criteria is they need to have less than FRS. Anything more, you may want to consider another way, which we will share shortly. And why do that? Because money can be withdrawn in small sums. So for those people who's clamoring, return my CPF, think about it. You can put in money, you can still take it out, but it's less in this case. Okay, for the third one is actually to use your ordinary account to maximize the interest by the three ways. Number one is to actually transfer your OA to your parents' retirement account. So it works like cash, but there is no tax relief. So this is actually if your parents really have a FRS, use your OA to contribute to your parents' RA. The number two is to contribute your ordinary account to your own special account for people who have low risk appetite. But then this is irreversible. So you need to think of a portfolio or how your asset allocation is going to change if you do that. Or if you are okay with higher risk, you can actually investment through the CPF IS approved, which we actually iterated on. So let's move on to the next session. So we have a special guest today. He's actually the blogger. So Lyndon, to you.
Okay. But I thought we just have a very informal conversation on some of the questions and prompters that we have. So I guess personally for myself, in the planning for CPF, it's not just me, but also my daughter as well. And of course, there's another good news coming up. My number 2 is coming in September as well. So it's
congratulations.
It's another new ball game, yes. But then of course, the past experience will help with the future ones. So I think the thing is that although I was actually rather late in the game, in fact, I just started really reading up and also like when I started my blog in August last year. So what actually changed my perception of life is when of course my daughter came to the picture. She was born like maybe 2 years ago. And then as a result, it's this mentality of planning in sustainability for life is what I feel is very necessary to start from young. And then I think also there's actually a misconception with regards to unlike those kind of bank promotions, you have your credit card hacks, etc. and stuff. The misconception is that the more widespread that hacks are being done within the CPF kind of environment, like CPF hacks, you see, the more likely you'll get shut down. Because the point is that the role of the stat board or the CPF, their long-term vision is definitely to enable Singaporeans to have a secure retirement. It is neither profit making, and as there's also no need to reduce costs by shutting down this called additional input, even out from the hacks. In fact, on the other hand, if more people are saving more from their retirement, it is actually a happy problem. So I guess like you and me as well as we have those hacks that PolicyWoke has done for the previous few sessions, right? It is definitely a good time to review while you're still young and able to plan for yourself in your retirement as well as your financial planning.
Okay, so Lyndon, so how do you exactly plan for CPF? So what is your mentality towards CPF in this case?
Okay, I guess in a way, CPF for me is a very long-term planning. It still goes towards my retirement planning. And actually, it's something that you can't be rigid about. In fact, this is where I also want to share of some of my movements due to the various environment factors that came to play lah. So actually, from actually last year when I first started out, I was very chiong, you see. Every month, do this OA-SA transfer, the max. My mortgage was also fully paid with cash. And then I did some kind of quite a bit of OA, a bit SA top up for myself as well as my daughter lah. Recent months, since March, there was a bit of a mindset change. Interest rates were continuously dropping. Then, of course, with the equities market and the financial market, there's kind of a dip, and the dip has also allowed many equities to be so-called at a very large discount. So in fact, this was a moment of time that as a long-term investor, as well as for your retirement planning, you need to be flexible in adapting to the various environment changes. And then this is where I started to cut back on using cash for my mortgage loans. I started to use my CPF-OA for my mortgage monthly repayments. And in fact, I stopped my old SA top-ups as well, and having more of a war chest or cash on hand to buy those equities on the dip lah. Yeah, so I think this is in a way showing that even though CPF is just one portion of your asset allocation, which we go into question 3 later. So there are many various multi-income streams that you should play around with to plan for long-term and secure retirement. Yeah.
I see. Okay, I think we have this idea floating around in the at least the financial planning. So there are actually people who are saying that CPF is not enough. It cannot cope with the rising healthcare costs. It cannot cope with the rising full retirement sum. People generally keep clamoring for return my CPF. So what I have actually discovered when I was doing a bit of planning for my parents because they are at 69 now and 69 and 70 and their asset is they're asset rich cash poor. So recently they actually sold their HDB and downgrade to a studio apartment. So from there I started to realize that was about 1 year ago. So I realized that actually for CPF, they have a plan for you.
Yeah.
So it's like for your MediSave, right? You are encouraged to buy medical plans really, so that you don't have to touch MediSave at all. So the MediSave amount inside, right, is more for like insurance. So the amount that's like 60K is meant to pay for your co-payment of the 5% up to 3K, man.
Yeah.
This 60K, if you divide by 3,000, it's like 20 years. So with 20 years, you every year have to go hospital. You pay 3K. With the interest, you still have enough in that case.
You're trying to max out the hospital beds.
Yeah. So in a way, it's like CPF actually have this plan. So if you do not embark yourself onto that plan, right, that CPF has already planned for you, you think that they are trying to get your money or that, then you actually shortchange yourself a lot already. Because if you did proper planning, CPF is more than enough. But if you don't do that planning, you don't buy the ISP, you don't invest your OA, or you don't keep your money, your SA, then you stepping to what they call it fail to plan basically.
What I find upsetting is that when you have people downgrading their integrated shield plans or even cancelling their integrated shield plans, that is really sad.
It is definitely sad. I mean, in a way, there's definitely some form of guiding principles at the so-called at a bird's eye perspective. Actually, downgrading of plans, I would say, is still acceptable. The minimum is you still need to have a hospitalization plan. Yeah, for the really in the case of very unfortunate and unexpected circumstances that you're hospitalized. In fact, more recently, just last month or so, right? It's very sway, but both my dad and my father-in-law went to the hospital one day apart on a Saturday and Sunday. And this is where, when we were being warded, right, you just realize that suddenly, like, this being warded for one night, somehow just the annual premium is more than pay the annual premium. No? In fact, the bills that came up after that, right, was about 2.5 times the price that you pay for 1 year's premium. And it's really instances like this that is unexpected that we really need to plan for. When we talk about insurance policies as well. Yeah.
So the both of them managed to claim or not?
Yeah, I managed to claim because at the point of being warded, I was helping them to verify that this is their insurance company, and then they sign for. So it means that no cash upfront. It is billed straight to the insurance cost. Yeah.
That's very good.
Yeah.
So that means the straight-through process for all these medical bills has already been well-oiled already in this case.
Yeah, in fact, it's very well oiled. I was expecting to minimally put down my credit card details, which this time round, from let's say from NTUC income as well as AIA, right? This process was really, I think it's very well done. It kind of sorts the anxiety on my side as a sole caregiver on the night itself. Because sometimes there's also a lot of admin work. And in your mind, it's really not thinking when your loved ones is already on their way to being hospitalized already. Yeah.
Oh, just a short question. Ethan, do you know if MCO card works for hospitals?
I never tried, but even if it works, still remember there's a 30,000 spending limit. So
Could be good thing, could be bad thing. Depends how you see it.
Yeah, there's a spending limit. But I knew that you cannot use MCO card to top up your EasyLink card via the ticketing machine.
Mm-hmm.
Yeah, I tried before, it doesn't work. Yeah.
That one need to use a GrabPay MasterCard.
Yeah, correct. GrabPay MasterCard works. Yeah.
So you top up your MCO card to top up your GrabPay MasterCard to top up your EasyLink card.
Yeah, but that works. I tried that before. Yes, I tried. Okay. Yeah. Okay. Anything next?
It depends on what you guys want to talk about CPF. So for me, I have had CPF until like crazy already. So I thought anymore, maybe CPF will come after me already.
That time Ethan, you shared about your OA, your SA, right? So
yes.
Is there any could we do a recap of that?
OA and SA. Okay, for me, because I have not met out my 60,000 amount, so I actually diligently put money into my CPF every month. So just to try to hit that 60K first. Then from that point, it's more about optimizing others' interest rates already. So I will definitely put more into CPF, but because I'm young, so I can actually dabble in very high risk one or higher risk one like stocks and shares already. So I'll definitely shift. But the 60, I'll take it as a bond component already in this case. Yeah.
So every month you put into, is it MA or SA?
GDC 3A because I'm still paying for a mortgage through CPF-OA.
Oh, right.
Yeah.
Personally, my plan was quite similar to Lyndon's. I have quite a bit in SA, not as much in MA, very little in OA. In fact, I moved as much as I could from my OA to my SA. So I'm already beyond the BRS. Planning to aim for FRS by age 55. Yeah.
So are you going to transfer your OA to your parents' RA in that case?
Yeah, that one is in the process, yes, because it helps to increase my parents' pocket money, I suppose. Yeah.
Do you still feel like the sandwich generation?
Not really, because OA is something that, to me, I think is something that needs to be managed. If it's too high, then you're getting suboptimal interest. So ideally, I want to shift it either to my SA, to my loved one's SA, as soon as I can. Yeah.
I see. Okay, what about Lyndon? Have you reached your BRS already in this case?
I think on a monthly basis, because I write my financial progress lah. So SA right now is 60% of our FRS amount. Yeah. Then if I were to calculate, it's about another 3.5 years for me to reach so-called the current FRS amount of 181. But of course, in 3 years' time, the amount will also rise lah. So I think roughly about towards the end of the 4th year, I'm about there already lah. Yeah.
So do you plan to transfer your OA to your parents' RA if you have the chance or not? Because if it's 60% of FRS, you already hit BRS already.
True.
Congratulations.
True. I guess in a way, it's also trying. It's a bit hard. It's a tough journey trying to convince your parents. One thing is about the hack. The other thing is for them, they would prefer cash on hand. Then on that case, I think it's better to respect their wishes. If not, wow, it's going to be a tough life ahead. Yeah.
But you think about it, your parents not yet hit the PEA, is it?
For them, they are already 60 as well as 67. Yeah. And it's more like all those kind of like sharing hacks would work already lah. Anyway, it's more like they prefer cash on hand lah. Yeah. So it's a bit hard to convince them otherwise lah. Yeah.
I thought there's this retirement sum top-up scheme where the government match $1 for every $1 that you put into their account.
That's
that is
below
quite recent.
60K, right? Below 60K, right? Yeah, so they are already above.
I think it was introduced very recently.
Very interesting. Yeah. That's good. Probably something to look at again. Yeah.
So for your parents, are they on the retirement sum scheme, the old scheme?
They are on the. My mom is on the RSS scheme because she does barely scrape through for. Yeah, I don't think she's on CPF Life, but my dad definitely is. Yeah. One is a firmer believer of CPF and the other less so. Yeah.
Actually, at age 67, you're getting every month some payment from the CPF board, right?
Oh yeah, but my dad, who is the more firm believer, right? He actually delayed the payout to 70.
Wow, fantastic!
Yeah,
fantastic.
Anyway, right now the way he's he's living off dividends from his equities. And then of course,
good. That's a good example, right?
Yeah, very good example. And really, the life that he leads is very simple. I can't just eat like 250 Thai fan every day lah. So it's really very like this, like curry and veggie, or just like a one or it's more like dinner between him, my parents, my dad, my mom, is like just one soup, one veg and rice. So it's very simple living. Yeah. Probably
sounds like a good retiree life.
Yeah. I'm not sure on that. It's a very, very frugal and way of living that will definitely stretch their dollars lah. But the younger generation now is like, if I work so hard for the first half of my life, and if I really want to retire with my cash, probably would that be the time where, instead of still being frugal, would I want to have somewhat of a bit of more lovely meals daily lah? Yeah.
Maybe your parents had very lovely meals in the past.
Yeah. Well, I guess we were there as well lah. So we probably know what was for dinner and lunch in the past as well. Equally frugal as well lah. So still very fond memories. Yeah.
I see, I see. Okay, I think due to lack of time, we have to proceed to the next section first. Okay, so we will actually talk about how to create your OA and SA shield. So the first step is just to apply for the CPF-IS scheme. Then after which, look for a low volatile fund with your OA or SA. So you have like 20K left in your OA and 40K in your SA. That's us constituting up your funds. Then just wait for 55 years old to arrive. So once the retirement fund is created, the OA and SA that is left inside CPF will go to RA. So you have your funds and you have your RA now. So you can just sell all your funds and all this money will go back to your ordinary account and a special account. So that's how you do the shield out and you fully protected your SA. So how you want to fund the rest of the RA, it can be via cash, it can be via other means, or even the OA that you shield down, you can still transfer it later. It's actually more flexible in this case. So for the second part, we are going to talk more about how to do a sort of a TEP shield. So you are actually advised to use ordinary account monies because there's at least a 2.5% opportunity cost. So you buy policy, second-hand policies that actually mature yearly or annuities. Maybe it's a big amount of annuity, like maybe at 50 or 100K. So because all these second-hand traded endowment policies, the investment return are at least about 3.5 to 4.6% projected. So if you look at it in this way, it's a better option for just a 2.5% guarantee. And if you manage to hold, most likely you can because you have ordinary account money. You will be guaranteed at least 2.2% before the last year of maturity. So in this way, 0.3% is very easy to hit, in my opinion. So that's how you can create another, maybe an endowment ladder or annuity to protect your future needs. So I think we are going to go to the part of our session. So Jimmy, maybe you can look at other questions that actually came up.
Okay, Ken. Right. Thanks, Ethan, David, and Lyndon on Fireside Chat. We hope you find it valuable for your own CPF accounts. We are now go for the Q&A section. So if you have questions but you haven't posted them, now is the time to post your questions in the comments as we are now addressing them. Okay, so we have one question from Benjamin. So he asks if you can share briefly again about what's the big value of hitting FRS earlier. So I guess he's trying to ask what's the benefit of reaching the FRS as early as possible? Yeah. So what's the benefit? Anyone?
Maybe I just come in first. Yeah. So even for me, hitting FRS even before I reach 40, to me is considered early since I started late into the game. Is to have a basket of funds, which is so-called safe assets. That is number one, still earning higher than normal interest as with regards to the Singapore context. And number two is something that is a basket that I won't be able to touch, and which means that I'm able to take on a bit of a higher risk with my other asset classes, whether I'm looking at like crowdfunding for IPS, P2P, equities, etc. Yeah. So it's actually to create a safety net, which I know that if let's say anything goes bad with another basket of assets, there's still this basket of assets that will definitely be there when I reach 55 onwards. Yeah, this is from my perspective.
I agree with the emotional stability part because you already know that there's something there for you. You don't have to be too conservative with your money. Because you already have set aside in your CPF. But to me, another thing is tax relief planning. So to me, that is also quite important. So I don't want to max out my FRS so soon. Actually, I plan to hit FRS just nice when I'm 55, just to max out that component. And so right now I'm thinking of how I can transfer my OA to my parents' accounts so that I don't have to move it to my SA. Yeah. Of course, I think it's also good to have cash outside, um, not not just for tax relief purposes, but also for higher return investments. Like for example, equities. Yes, it's been down in March. It's gone up quite a bit since then, but who knows? Maybe it's good to take some profits off the table. Maybe there might be some downturn. If there is a downturn, like, would you be ready to put in another batch of money? If so, then yeah, you don't have to take money off the table. But if let's say you are quite fully invested now, maybe it's good to take some money off and be ready for the next buying cycle. Yeah.
For me, I actually echo what David said, especially on the tax relief planning part. Because if you hit FRS, you want opportunity to reduce tax at 7K. So that's what you do not off, especially if you are maybe at the higher income, at least 11%. If it's not 11%, at the tax rate of 11%, it is fine. So you don't have to bother about this. But if you are, then it really makes a lot of difference because in of like what Lyndon mentioned, the whole bird's eye view about your asset, right? You don't want to contribute too much into a safe yielding special account at 4%, because that will actually bring down your overall returns too low. So the weightage of maybe like a bond-like component or a safety net should be lesser in this case, and you should invest more aggressively, especially like if you got 30 years, come on. So markets will always go higher even after 30 years, right? It's almost certain unless.
Yeah,
So yeah, it makes sense if you do that.
Yeah, maybe I just come in. There's one more point. Yeah. So actually, in a way, it's true that trying to max out your FRS too young, you'll be so-called compromising your tax relief when you are reaching a high income in your later part of the years. Okay, honestly speaking, for myself, I don't see myself earning very high income as a salary employer. That's one. And then, of course, for me personally, building a family is also one of my life goals. A big family. Anyway, children also, they will form one of your tax relief. So,
Yes.
ladies and gents out there have more kids. Every kid is like 4K. Tax relief. So, in fact, actually, the even for mothers, it will be even easier for them to hit the max tax relief, So in that case, even for my wife, then I'll be telling her, there's no harm maxing your FRS early in life. Seriously, yeah.
Yeah, so that's a very good perspective, especially for mothers. They do not have the benefit of tax relief also. It's maxed out already anyway.
Correct.
Yeah. So for you, do you plan together with your wife, or your assets are actually separated in that case?
I guess in any family pack, like even for wolves, there's only one leader. And definitely it makes the process easier. I mean, for her, it's more of a career first. For me, that is probably due to my job nature as well. And of course, that's why I'm very interested in this area of in investing planning as well as retirement planning. So the family follows my lead in this aspect. Yeah.
Okay. What about David? What about you?
Actually, one more aspect about having children, right, regarding tax, is this thing called is it PTX, parent tax
PTR,
rebate?
parent
PTR.
tax relief.
Yeah, I think this is a fantastic thing. So if you have 3 children, I think you don't have to pay income tax for maybe 10 years at least.
Depends on your annual income as well. So it will vary accordingly.
Yeah, but it's quite a big sum. Yeah.
It's a big sum, definitely. Yeah.
Okay, it sounds like you guys are encouraging giving birth. How?
Technically, it's the policies that's encouraging. But maybe people don't know about these policies. So education plays a big role also.
Yeah, I do agree.
I guess it's more like people don't look at the policies first before they plan for their kids. It's more like after they have their kids, then they look at what kind of relief or tax rebate can I get. I wouldn't go the other way around because having a very high tax relief or rebate, right, may not actually encourage more people to have more kids. Because in the other, it's a double-edged sword. So what comes with relief, it also means that you're spending more also, whether for their necessities, their education, and their life as a whole. Yeah.
That's why you have the child baby bonus.
Yeah.
Every child that you have, your baby bonus goes higher and higher.
Yeah.
So in a sense, that encourages too.
Definitely.
So it's a lot about understanding how the policy, after the policies are done, what's your bird's eye view and how it actually relates to your own financial situation in that sense.
That's why it's very important to understand policies first. From a very first-hand experience, you read up on it, you ask questions. There are no silly questions. You just try to clarify as much as you can, rather than bashing on the negativity of them right on the start. That goes with any scheme, your IRAS tax scheme, your CPF, as well as all your other family schemes as well. Yeah.
That's really a lot of insight from Lyndon, really.
Yeah.
So, do we still have any other questions?
Yeah, there's no more questions so far. So there's only one. Yeah. Okay. So if there is any more questions from the rest of you?
I'm good. Yep.
Don't have, right? Okay, Ken. So with the interest of time, then we are going to end this episode. Yep. So with that, for those of you viewers, we thank you for tuning in and all the questions you have for us. But this episode is it's not over yet, and it will remain as a video in our Facebook page. So if you still have questions with regards to CPF hacks, feel free to post questions in the comments of this Facebook live video. All right, and we will address them during the next episode. So as you can see in the current slide, is the QR code, whereby if you scan the QR code, it will give you access to the links to our social channels. So from the page, you have direct links to our website, Facebook page, YouTube channel, and our Telegram channel. So as for our Telegram channel, you have access to the table of the traded insurance policies that we have. So if you want to find out more about the traded insurance policies you have, do join us on Telegram and reach out to us via Telegram, and we'll get back to you. Okay. So speaking of the next episode, do join us next Friday, 5 p.m. for JEDi episode 12 on investments part 1. If you like our content and be notified for future episodes, do like our Facebook page, do like this Facebook live video, and share this video. We hope to see you next Friday, and
may the finances be with you.
Okay, goodbye.
Thank you. Bye-bye.
Okay, thanks, Lyndon. Goodbye.
Okay, thank you.